Hi, this is Shade with Tax Sale Support with another video in our Tax Sale Fundamentals series. Now, the video that I wanted to talk about, or the topic, is tax liens versus tax deeds. Which one is better? Now, this is a question that we get on a regular basis, and so I think it's a good one to address here because a lot of this comes down to your fundamental understanding of how tax liens and tax deeds work. Now, the answer as to which one is better is really a personal answer. It's one that can apply to each individual, and that's because it depends upon your objective. They are two totally different types of investments that have different outcomes, and they also carry different degrees of risk or work or effort that are involved. So let's first just talk about tax liens for a minute here. Because when you're purchasing tax liens against properties, you're not actually buying property, you're just purchasing the liens against properties. And so you are once removed, I guess you could say, in that situation versus buying actual property, which reduces your overall risk. But again, the tax lien has incredible power. So tax liens are a fantastic way to earn annual rate of return, I would say ranging from 12 to 20%. Okay, that's an easy thing you can do. You get checks in the mail every time a tax lien redeems, which means that the property owner paid off the county what they owed in delinquent taxes and fees, and the county then sends you a check after the lien is redeemed for your initial investment plus your interest rate that you'd earned up to that point. They are very low maintenance, okay, meaning that the vast majority of liens redeem and they will redeem at different points throughout the redemption period. But it's only those that don't redeem that you would have to initiate or pursue foreclosure on, which is not a high percentage of the liens. Now, you have a chance to acquire property with tax liens, but that's not what the objective is. One thing to understand about tax liens is that they're designed to redeem. That's the way they're supposed to work. Where they create a way for the county to collect the delinquent money that's owed to them right now, even though the person is delinquent and they can't pay it off right now. It's a way to give people the chance to keep their property even though they can't afford that bill. So really, they're an incredibly fair system, and tax liens are perfect for many investors. Okay, but again, if you're investing in tax liens, then most likely what you should be going for here, or what your objective should be, is earning that high interest rate return annually. Okay, so it's all about buying these liens and earning those checks in the mail from, ranging between 12 and 20% annually. Okay, now tax deeds are a different story. We're talking about property acquisition here. So with tax deeds, we're talking about buying properties that have already been foreclosed on. So they are there to purchase at the tax sale. When you bid up on them, you're bidding the actual buying price for the deed. And what you receive is a tax deed from the county. Now, this is a traditional buy low, sell high strategy. Uh, there are options, though, and things you need to understand about this. And that is, you need to understand what your exit strategy is going to be going into it. In other words, do you plan to flip this property? Do you plan to try to keep it long term for rent, or to maybe offer things like owner financing on it? How are you going to monetize this property? Is one of the questions you have to answer as you're buying tax deeds, so they are more involved. There is more time that's required in order to determine some of these things, but there's also a greater chance for more reward. Okay, so you have the opportunity for lump sum returns with tax deeds, meaning that you could buy a property and turn around and sell it for a profit, or even if you keep properties long term, you can still make a lot of money from it. But we have two totally different paths here that require different amounts of time. The path here on the left does not require a lot of time. The tax liens, that you don't have to be time intensive with tax liens. In fact, there are types of tax liens you can buy where you don't have to spend much time at all with doing it. But on the tax deed side, this is going to require more time, but at the same time, it doesn't necessarily have to require a lot of money. So for people that are in a situation where, let's say, they don't have a lot of capital, then tax deeds are most certainly the way to go, because what you need to do in that case is take a small amount of money and turn it into more. So the fastest way to do that is through buy low, sell high, and being able to create a process that you can duplicate over and over again. So just a couple of quick examples of situations here, and I want to talk about which one of these would probably work best for each investment. So the first one is if you want property. If you want property, we're always going to direct you towards tax deeds or maybe redemption deeds, depending on which state you're looking at, but it's always going to be towards property acquisition. If it's security that you want, if it's just a good, safe interest rate return without spending a lot of time or effort in doing it, then tax liens would definitely be the way to go. Now, as I mentioned before, if you have very little starting capital, okay, so let's say you have $5,000 to work with right now, and that's it, then definitely what we would tell you to go after in that case would be tax deeds. And I would even have, I'd be more specific than that. I would say low dollar tax deeds in that. So in other words, you're looking at buying low dollar tax deeds that you can turn around and sell at a profit. So for that case, tax deeds are most certainly going to be the way to invest. You wouldn't want to take that $5,000 and invest it into liens, because you don't know when those liens are going to redeem, and they have the potential to be a long time, and you really don't have that kind of time with the given capital. You need this capital to perform as well as it can within a short period of time, and so you're looking for short-term investments and processes there that you can duplicate over and over. So if we're talking about things like retirement funds, self-directed IRA or 401k, funds like that work tremendously well for either. You can use those types of funds to buy either tax liens or tax deeds, and either one of them will work equally well. It depends on what your interest is. For those that have no time but they have the capital, we would say secondary tax liens are the answer for you. And that's because secondary tax liens are a very easy way to invest in liens, get all the benefits of liens without all of the time requirements that you would normally have. So it would definitely be the way to go for those that just don't have the time to do all of this, to try to learn all of this. They just basically want a way to put their money away and make a good rate of return on it. That's definitely what secondary tax liens work best for. So uh, we appreciate you watching the video, and hope you'll subscribe so that you can watch the next one we come out with.